Ladies and gentlemen, good day and welcome to the Hindalco Industries Limited Q4 and full year FY20 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on the touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Praveen Singh from Investor Relations of Hindalco. Thank you, and over to you, sir.
Thank you, and a very good evening or morning to everyone. I hope you all are safe and in good health. On behalf of Hindalco Industries, I welcome you all to this earnings call for the fourth quarter FY20. On this call, you will refer to the Q4 investor presentation available on the company website. Of the information on this call may be forward-looking in nature and be covered by the safe harbor language on slide number 2 of the Q4 earnings presentation. In this presentation, we have covered briefly our action towards maintaining safety, operational stability and liquidity in the COVID-19 environment. Later on, we have presented the key highlights for the fourth quarter and full year 2020 and a comparative financial analysis of our business segments in India and our overseas subsidiary, Novelis. All the prior period numbers have been regrouped and reclassified as per the Ind AS and presented in a similar manner for comparison purpose. On today's call, we have with us from Hindalco's management, Mr. Satish Pai, Managing Director, Mr. Praveen Maheshwari, Chief Financial Officer and CEO of Copper Business. On Novelis' management, we are joined by Mr. Steve Fisher, President and CEO. I would now like to hand over the call to Mr. Satish Pai for his opening remarks. Thank you, and over to you, sir.
Thanks, Praveen, and greetings to everyone. Thanks for joining the conference call of Hindalco for fourth quarter FY20 earnings. Before we discuss our performance for the quarter, let me start with a quick update of our actions related to the COVID-19 pandemic on slide 4. Our first and most important objective has been to protect the health and safety of our workforce across all our facilities. We have taken several precautionary measures which will remain in place until the pandemic crisis is resolved. Employees at our offices in metropolitan areas have been asked to work from home as much as possible. Non-essential business travel has been suspended. Stringent safety measures are in place, including social distancing at workplace, sanitization of all premises, getting people back to office in stages, and stress testing our preparedness through mock drills. We are also active in the surrounding communities with drives for distribution of masks, sanitizers, PPEs, and food. Now turning to our operations, Hindalco's 4 aluminium smelters and the Utkal refinery in India operated at near full capacity during the lockdown. Our coal and bauxite mines also operated at regular scale. We are exporting more than 80% of our total output to countries like Korea, USA, Malaysia, Brazil, Japan, while minimizing our inventory build-up and absorbing the plant fixed costs. Our aluminium downstream plants in India had shut down initially, except for 2 that continued to operate and serve essential sector customers. We have since restarted downstream operations at reduced capacity to meet the existing market demands. After initial temporary shutdowns, our copper operations have restarted and are now stabilizing to reach optimal levels. Temporary or partial shutdowns were taken in Novelis automotive plants across the region due to customer shutdowns, reduced demand, or by government decree. The plant schedules are being adjusted to be in line with latest customer demands. All capex, excluding maintenance and essential capex for the next year, is being curtailed in India and Novelis. All businesses are focusing on fixed cost reduction and maintaining adequate liquidity to sustain plant operations in the current environment. Coming to slide 6, let me now present the key highlights of our quarterly performance for Q4 FY20 versus Q4 FY19. Hindalco delivered yet another steady and strong quarterly performance, reflecting its resilience to withstand market cycles. This performance was driven by record financial performance by Novelis, coupled with lower input costs and stable operations in the Indian business. To begin with, Novelis net income without exceptional items was 153 million, up 18% year-on-year. Novelis reported its highest ever quarterly adjusted EBITDA of 383 million, up 7% year-on-year. It also recorded its highest ever quarterly EBITDA per ton of 472, which is the best among global peers. Novelis continues to maintain its strong liquidity position of 2.6 billion as on March 31st, 2020. In April, Novelis completed the Aleris acquisition, and the integration process has started to drive synergies and long-term value. Moving on to Hindalco India Aluminium business performance in Q4 FY20. EBITDA for Hindalco India Aluminium, including Utkal, was 1,039 crores, up 3% year-on-year, despite a challenging business environment in Q4 FY20. The EBITDA margin was at a healthy 20% and probably the best in the industry currently. The business recorded highest quarterly aluminium metal production of 327 KT, up 2% year-on-year despite COVID-related challenges. Aluminium metal sales were at 314 KT in Q4 FY20, even though domestic market conditions were tough. Sales of aluminium value-added products, excluding wire rods, was at 76 KT, down 8% year-on-year due to the lockdown impact. Utkal Alumina delivered its best ever production of 441 KT in Q4 FY20. Muri Alumina Refinery has restarted operations in December 19 and was ramping up to strengthen our integrated value chain. The Utkal expansion project of 500 KT is on track and expected to start in Q4 of FY21. Turning to the copper business quarterly performance in slide number 7, copper EBITDA in Q4 FY20 was 406 crores, up 9% year-on-year with a margin of 9%. Value-added CC rods touched a record quarterly production of 71 KT and grew by 15% year-on-year. VAT sales were at 73 KT, up 4% year-on-year, with the share of VAT to total sales reaching a record high of 86% in Q4 FY20. Overall, copper metal sales in Q4 FY20 was at 86 KT in FY20, down 14% due to lower dispatches in the month of March due to the lockdown. The benchmark TCRC for calendar year 20 has settled at 15.9 cents per pound, which is 23% lower than the last calendar year. Now let's look at our quarterly consolidated performance for the year. Hindalco's quarterly consolidated EBITDA was at 4,173 crores in Q4 FY20, up 6% year-on-year compared to 3,938 crores in Q4 FY19. Consolidated EBITDA margin stood at 14% in Q4 FY20 versus a margin of 12% in corresponding quarter last year. The consolidated profit before tax, before exceptional items, was 1,395 crores in Q4 FY20 as compared to 1,725 crores in Q4 FY19. The PBT has an impact of rupees 568 crores of the one-time finance cost in Novelis. Consolidated profit after tax in Q4 FY20 was 668 crores compared to 1,178 crores in the corresponding quarter of the last year, also impacted by the 568 crores of the one-time financing cost in Novelis. In January, Novelis successfully issued 1.6 billion bonds at 4.75 due in 2030 to replace one of the existing 1.15 billion bonds at 6.25 that was due in 2024. This offering extends the debt maturity profile at an attractive rate with a net interest savings of around 17 million per annum. Hindalco reflects a strong cash position at the end of March 31st, 2020, in Novelis at $2.4 billion and in India at around 9,900 crores. The consolidated net debt to EBITDA stands at 2.61 at the end of March 2020, as against 2.48 at the end of March 2019. Now turning to the broader economic environment in slide 9. Global lockdown measures to prevent the spread of COVID-19 are severely impacting economic activity. IMF's April forecast of -3% contraction in global GDP growth versus 2.9% growth in CY19 is much worse than the 2008-9 crisis. Both the emerging and developed economies are expected to degrow in CY20, with the contraction expected to be more severe in developed economies. These forecasts are subject to downward revision in case the pandemic rolls over to the second half of calendar year 20. The impact of this pandemic was visible in Q1 calendar year 20 GDP growth numbers, with the US, China and the Euro area GDP contracting -5, -6.8 and -3.3 respectively. Easing of lockdown measures in most countries and the announcement of fiscal packages by various governments are expected to provide some boost to economic activity gradually as the world learns to live with the virus. The shape of the recovery, U, V, L, will however depend, varying on how effectively these fiscal measures are implemented across the various countries. The key risk to watch out in 2020 will be the escalation of US-China tensions and its corresponding impact on global growth in calendar year 20 and 21. Turning to the Indian economy, GDP growth in Q4 FY20 sloped to 3.1%. As a result, the full year FY20 GDP growth fell to an 11-year low of 4.2%. This slowdown was primarily due to degrowth in manufacturing and construction sectors. The full impact of lockdown will be visible at the end of Q1 FY21 as most monthly indicators are in the red in April 20. On the positive side, however, as a part of the Unlock 1.0, India has started easing some restrictions from 8 June and is restarting economic activity. This, along with the government's economic stimulus package of 10% of GDP, is expected to revive growth in a calibrated manner. On the monetary policy front, RBI's benchmark policy rates now stand at a record low of 4%, with cumulative rate cuts of 115 bits in 2020. Let me now take you through the aluminium industry overview on slides 10 and 11. Global consumption growth in 2019 declined by 1.6%, the lowest level since the global financial crisis of 2008 and 9. The prolonged US-China trade war and sluggish industrial activities across regions dampened consumption growth during the year. In 2019, demand in the world excluding China contracted by 3.5% versus a growth of 2% in 2018 due to subdued demand in regions notably US, Italy, Japan and South Korea. Chinese demand was flat in 2019 as compared to a 4.1% growth in 2018. Across regions, slow growth in end-user industries such as automotive, construction, electrical power, and machinery and equipment were the primary reasons for the significant drop in demand in 2019. In Q1 of calendar year 20, in the backdrop of COVID-19, global demand has declined by 9.3%. On the supply side, global production declined by 800 KT to around 63 million tons in calendar year 2019, as Chinese production declined by 3% on account of disruptions at two major smelters, whereas in the rest of the world, production grew by 1% in 2019. The overall market deficit in 2019 was around 1.1 million tons, as against 1.3 million tons in 2018. Global demand in 2020 is projected to fall sharply by 8% in the backdrop of the COVID-19 outbreak. The world excluding China consumption is likely to contract 13% due to severe slowdown in manufacturing, particularly in the automotive sector and due to weak customer sentiment. In China, demand is likely to decline by 4%, with some green shoots due to recovery in demand led by auto and construction. Global aluminium prices witnessed a significant decline of 15% in 2019 to 1,791 per ton versus 2,110 in 2018. In Q1 of calendar year 20, the average global aluminium prices have declined further to 1,690 per ton. Coming to slide 11, in FY20, domestic demand for aluminium declined by 6% to 3.7 million tons. Imports, including scrap, degrew also by 6% on sluggish demand in the domestic market. Despite degrowth, imports maintained a market share of around 58% in FY20. Domestic sales declined by 6% to 1.55 million tons in FY20. Domestic demand registered a consecutive decline of 11% year-on-year to 905 KT in Q4 FY20. Imports, including scrap, also recorded a degrowth of around 4%. Domestic sales also sharply declined by 19% year-on-year to 376 KT in Q4 FY20. The continued slowdown across all user industries such as electrical, automotive, building and construction were the primary reasons for the sluggish growth in consumption during the quarter. Domestic demand for aluminium in FY21 is likely to continue to be subdued. The government's recent announcement of a stimulus package of 20 lakh crores and its thrust on infrastructure, housing and electrical sectors will help offset the negative economic sentiment post-COVID to some extent. Moving to slide 12, the global FRP demand in the near term will remain soft in the cyclical end market resulting from the COVID pandemic. In the current situation and post-COVID, industries like beverage, food packaging, pharma will tend to benefit, leading to a higher demand for FRP in these segments. Beverage can sheet market has historically been a recession-resistant product and is expected to remain resilient in the current environment, particularly in North America and Europe. With the rising preference for sustainable beverage packaging, aluminium will continue to drive demand for beverage can sheets going forward. Currently, the global automotive industry has seen adverse effects due to COVID-19 as some automakers had temporarily ceased production. Aluminium FRP demand for automotive body sheets driven by light-weighting trends in the transportation sector, premium vehicles and EVs continues to see traction and some positive signs of revival with growing demand for automotive, majorly in the US, Europe and China. While the major US and German automaker restarts are some positive signs for the automotive market, but broadly speaking, it's still unclear as to how much the COVID-19 will impact overall near-term auto demand. In the aerospace segment, reduction in production is seen as consumer travel is expected to drive lower demand in the next year. FRP growth in the aerospace segment, though, remains intact with high order backlog from all aircraft manufacturers across the globe. Domestic FRP demand in India is contracted by 9% in Q4 FY20 and by 3% in FY20 year-on-year due to subdued demand in transportation, building and construction and electrical sectors. Currently in India, industries like food packaging, pharma, beverages and litho are pushing domestic demand for FRP, and this is expected to grow further post-COVID. Turning to the copper industry on slide 13, global refined copper consumption contracted by 0.7% in 2019 versus a growth of 2.9% in the previous year. In China, consumption growth moderated to 1% in 2019 versus 5% in 2018, whereas consumption in the rest of the world contracted by 2.3% in 2019 versus a growth of 1% in 2018. This drop in copper consumption of the world ex-China was driven by weak manufacturing activities in Europe, majorly Germany. In Q1 of calendar year 20, owing to COVID-19, the global copper consumption saw a dip of 10% versus the same quarter last year. All of this degrowth has come from China, which dipped by 22%, while the world ex-China growth remained flat for the quarter. On the copper concentrate side, mine disruptions in 2019 were comparatively high. Copper concentrate consumption grew by 1.6% to 16.8 million tons in 2019, compared to a growth of 3.1% a year ago. Concentrate market recorded a deficit of 168 KT in 2019 versus a surplus of 141 KT in the previous year. Owing to the lesser demand by smelters in China as an impact of COVID-19, copper concentrate consumption saw a dip of 2.7% in Q1 calendar year 20. This has led to a temporary rise in the spot TCRC from 11.5 cents per pound in Q4 calendar year 19 to 15 cents a pound in Q1 calendar year 20. Going forward, uncertainties related to COVID-19 and other macroeconomic environments across the globe are going to impact copper consumption in calendar year 20. At the same time, various stimulus packages declared by different countries may provide some support to overall copper demand. We expect the global demand for refined copper to be around 22 million tons in calendar year 20, down 5.5% compared to the last year. On the supply side, COVID-19 pandemic has impacted the southern hemisphere in a big way, and many large mines, especially in countries like Peru, Panama, etc., have already declared force majeure. We expect the copper market to be in a deficit of around 400 KT in 2020 and will put further pressures on the spot TCRC. In the domestic market, the consumption of copper recorded a marginal growth of 2.5% year-on-year in financial year 20 to 750 KT. Sluggish demand in FY20 can be attributed to weak demand from transportation and the power sector. Post-imposition of CVD on import of wires from Malaysia, Indonesia, Thailand and Vietnam, shares of imports have reduced to 32% in Q4 of FY20, and this was 52% in Q3 of FY20 and 37% in Q4 of FY19. This will certainly help domestic producers to increase their market share going forward. Praveen will now take you through the business performance highlights of each of the business segments in Q4 and the full year.
Thanks, Satish. Let us review our operational performance on slide 16 now. Novelis delivered yet another strong and steady quarterly and full year performance in 2020. Novelis registered its best ever adjusted EBITDA and EBITDA per ton for the quarter as well as for the full year 2020. Can sheet shipments were 66% of the total product mix in FY20 versus 63% last year. This remarkable performance was on the back of strong operating and financial performance supported by favorable market conditions. Overall shipments for the full year were 3,273 KT in FY20. Beverage can sheet shipments grew 4% year-on-year in FY20, driven by rising consumer preference for sustainable packaging. All the organic expansion projects in the US, China and Brazil are progressing well. On April 14, 2020, Novelis completed its acquisition of Aleris and has begun integration of their operations to drive the synergies. The divestment procedures for automotive assets at Lewisport in the US and Duffels in Europe are underway. This acquisition will provide further product diversification with addition of high-end aerospace and expanded specialty capabilities. Recycled content utilization in Novelis continues to be high at 60% in FY20, and Novelis has a very strong liquidity position of $2.6 billion with cash and cash equivalents of $2.4 billion at the end of March 31st, 2020. Moving to slide 17, related to financial performance of Novelis. Novelis achieved a revenue of $11.2 billion, an all-time high adjusted EBITDA of $1472 million, up 8% YOY, and a record EBITDA per ton of $450 per ton, up 7% YOY in FY20. This growth was on account of portfolio optimization, favorable metal prices, better cost efficiencies, and favorable foreign exchange, but partially offset by less favorable recycling benefits due to lower aluminum prices. Slide 19 shows the details of the performance of Indian aluminum business segment. Alumina production in Q4 FY20 was 720 KT and 2,735 KT for the full year 2020. Utkal Refinery achieved a record production both in Q4 and the full year FY20. Muri Refinery has also started operations in December 2019. The aluminum metal production was at a record high of 1,314 KT in FY20, despite some disruption in the month of March due to COVID. Value-added products, excluding wire rods, recorded a production of 79 KT and 319 KT in Q4 and full year 2020 respectively. Coming to slide 20, aluminum metal sales volumes were at a record high at 1290 KT in FY20, up 1% YOY. This was achieved despite challenging market conditions. In Q4 FY20, metal sales were 314 KT versus 325 KT in the previous year, down 3% YOY only due to the COVID impact. Value-added product sales, excluding wire rods, were lower by 8% at 76 KT in Q4 on account of low offtake in the month of March 20 again due to the pandemic. VAP sales in FY20 was higher by 2% YOY at 306 KT in FY20, with share of VAP in total sales maintained at 24% in FY20. Moving on to the financial performance of the aluminum business on slide 21. This segment recorded a revenue of 21,749 crores in FY20 versus 23,775 crores a year ago, lower by 9% on account of lower global aluminum prices. EBITDA in Q4 FY20 stood at 1,039 crores versus 1,010 crores in Q4 FY19, higher by 3% year-on-year. The EBITDA margin in Q4 20 was at a very healthy 20% of revenue, despite the current challenging macroeconomic business environment. EBITDA in FY20 was 3,729 crores for the full year versus 5,096 crores in FY19, lower by 27% due to lower realization, primarily partially offset by lower input costs and better efficiency. EBITDA margin for FY20 was at 17.1%, one of the best in the industry. Moving to slide 23, the overall copper metal production was lower by 16% YOY at 75 KT in Q4 20 compared to 89 KT in Q4 19, while quarterly production of CC rod was higher by 15% YOY at 71 KT in Q4 20. CC rod achieved an all-time high production of 263 KT in FY20, up 7% YOY. DAP production was lower by 8% and 24% YOY Q4 and full year respectively compared to last year. Coming to slide 24 on sales volume of copper and its VAP. Copper metal sales were lower by 14% year-on-year at 86 KT in Q4 20 due to lockdown impact and 7% lower year-on-year at 335 KT in full year 20. Although the copper value added, which is CC rod, its sales were higher by 4% in Q4 and 6% in full year 20. The financial performance of the copper segment is on slide 25. Revenue stood at 18,533 crores in FY20 versus 21,198 crores a year ago, down 17% primarily due to lower LME and volumes. EBITDA stood at 406 crores in Q4 FY20 versus 373 crores in Q4 19, higher by 9% year-on-year, despite challenging market conditions. The full year 2020 EBITDA stands at 1276 crores versus 1683 crores in FY19. This was lower by 4%, primarily due to lower volumes and realization. Turning to consolidated financial numbers for the full year 2020 on slide 26. Hindalco reported a consolidated revenue of 1,18,144 crores and an EBITDA of 15,536 crores, profit before tax and exceptional items of 6,208 crores, and profit after tax of 3,767 crores in full year FY20. The detailed quarterly comparative financial numbers are attached as an annexure to this presentation on slide 31. Hindalco India business reported a revenue of 40,324 crores, EBITDA of 5,483 crores, and profit after tax of 958 crores in FY20. These details are provided as an annexure to this presentation on slide 32. Let me now hand over the call to Satish to give you a brief on our concern on the update with our key portfolio.
So let me conclude with some key takeaways of today's presentation, which is really about navigating through the current crisis while retaining our focus on the value accretive long-term growth plans that we have. Our top priority is protecting the health and safety of our employees and community, taking all the precautionary measures and creating essential infrastructure in all the plant locations for contingencies. Our early preparedness and appropriate actions are helping us manage this tough and uncertain situation well. Second is our relentless focus on efficiencies and cost competitiveness, as Hindalco smelters continue to be in the first quartile of the global cost curve. Capacity expansion at the Utkal Alumina refinery will further help in reducing our overall integrated cost of production going forward. The company is focused on cash conservation and maintaining adequate liquidity to sustain plant operations in the current environment. We will tightly control capex for the next year while prioritizing only essential capex to maintain the balance and ensure future competitive readiness. Our business model of being 80% LME linked in terms of EBITDA and our long-term strategic investments in Novelis and the Indian downstream expansion will enhance our capabilities. In addition to this, the acquisition of LRS will provide further product diversification in Novelis to strengthen our long-term sustainable business model. We continue to manage the current situation with agility, and we believe that with all the support from government and our employees, we will come out of these challenging times together stronger than ever. Thank you very much for your attention, and we now open the forum for questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hello, sir. Thank you for the opportunity. A few questions from my side. First, the government announced the composite auction of coal and bauxite mines. Do you think you will be interested in that, given that we are almost 100% integrated in bauxite? And do you think it will lead to higher smelter capacity addition in India per se by newer players?
So the whole point of the government doing this is to ensure that more capacity comes in. Now the timing of that capacity is going to be important because India today produces about 4 million tons and consumes nearly 3.7 to 4. But if there is a growth rate, if you can even assume 6 to 7%, the government is fully aware that in 5 years' time we are going to be importing a lot of aluminium, and hence they are trying to make it attractive. So as you say, I think Hindalco at this stage is not looking to expand. But I think that, they have announced it. It's going to take them a while to come with the package of a bauxite and a coal mine together. And I think that probably this will only happen, in my opinion, probably a year or 2 years down the road. I think that initially you are going to see some commercial coal blocks coming up for auction. And we'll be certainly looking at that first. I think the combined thing will take them some time to actually get the specifics to make it happen.
Thank you very much. On copper, we have seen a significant jump in margin. So how much of it is due to the spot that we see increasing, and how much of it do you think will actually taper down to the course of the rest of the fiscal year?
Yeah, so I think I need to explain this point a little bit. In copper, there is a concept of derivative accounting that we do. As you are aware, copper is a business which is fully offset hedged. And we have two kinds of exposures. One is the commodity exposure, and the other is the currency exposure. When we buy copper concentrate, it is more like a 3 to 4 month cycle, before which we actually get the concentrate, we process it, and then sell it. So to avoid any undue gains or losses due to commodity price fluctuations, we sell on the exchange when we buy copper concentrate. And similarly, when we sell physically, we unwind the hedge and thereby compensate either gain or loss on the exchange. So the amount of gain that we make on the commodity on physical side is offset by the loss on the derivative side and vice versa. And the same thing applies on the currency side as well. We use buyer's credit as a hedge against our dollar liability, and that's how we are able to safeguard ourselves. The issue that is there is, while it is true economically that there is no gain or loss coming from these derivatives that we take, and therefore we are completely safeguarded, in accounting it does not exactly follow the same method, because the derivatives and the physical side do not go hand in hand in each month or in each quarter. So in a particular month or a quarter, you might see some fluctuations in profits and losses coming in because of this fact, whereas on the longer horizon, you will not see any major difference, which means the gains and losses will actually cancel out each other. Now, this gets accentuated in times when the commodity prices are moving wildly. So if you notice, in the last 6 months, the commodity price, copper price, has gone up and down from the high of $6,000, $6,100 to a low of below $5,000 as well. Similarly, rupee-dollar exchange rate has widely fluctuated in the last few months. These create noises in the accounting which reflect in the form of a higher gain or loss in any particular month or quarter. Now, in this particular month and quarter, actually, the last quarter, we saw some significant gains coming from purely derivative accounting. In our opinion, this gain is roughly about 100 crores, which has flown into the books. It is not as if this gain is not there; it is there, but there would be some countering loss sitting somewhere else, either in the previous quarters or in the future quarters. So I would say the real performance for copper should be taken as about 300 crores, whereas in accounting it would be reflected about 400 crores.
Thank you for the elaborate answer. Last question from my side. When you mentioned that it will be only maintenance capex this year, can you quantify how much of it will be? And will there be any capex on the Utkal expansion?
Yeah, so on the Hindalco India side, we have cut the capex down to 1,500 crores. Our original plan was around 2,200, 2,300. And the 1,500 crores has got about 350 crores of the Utkal expansion. So if you really look at it, our normal maintenance capex along with some other smaller projects should be around 1,000, 1,200. So we have dramatically cut our capex back down to that maintenance plus very important projects, which are either environmental or maintenance related, and the Utkal expansion. And the rest we are postponing a little bit.
Thank you. That's all from me.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, we would request you to please limit your question to 2 at a time. The next question is from the line of Anuj Singla from Bank of America. Please go ahead.
Yes. Thank you very much for the opportunity. So, Mr. Pai, firstly, if you can talk about how the aluminum division has done on the COP side in this quarter, and what is the outlook going into maybe FY21 or the first quarter of FY21, given that there is a lot of tailwind from the coal side, given improved availability from Coal India. So any color will be useful, sir.
Yeah, so I am trying to remember the last time I had said that probably Q4 COP will drop another 2%, actually dropped by nearly 5%. So Q3 to Q4 the COP dropped by 5%. And we now know, because we are already in the middle of June, in Q1 it's going to drop another 5% from Q4 levels. So we are seeing a lot of tailwinds on the cost of production side. Coal is certainly a biggest one, but also CP coke, pitch, caustic, all of them are quite favorable. Furnace oil, everything is quite favorable right now.
Okay. That's useful, sir. And sir, in terms of hedging for the aluminum side, would you have an update for FY21 again, sir, or what kind of hedging is already in place?
Yeah. It's just a standard question, so I'm prepared for that. So for FY21, we have actually been quite active. We have 38% total commodity hedge at $1,732 per ton. Out of which 2% is a rupee LME at 1,70,640 per ton, and 36% is only commodity at 1,711. And the currency overall is 37% hedged at 75.93, so nearly 76.
Okay, wonderful. And so lastly, on the Utkal side, like you said, the 500K expansion is going to be commissioned this year. So is there a scope of portfolio optimization in the alumina, among the alumina locations, including maybe, the high cost locations like Muri, where at the present alumina prices, I don't know if these locations are still profitable. So can you share some thoughts on how the alumina ramp up is going to impact your overall alumina sales and maybe cost savings in that division?
Yeah, I think that, I think we have said this before. We'll probably ramp down first the Renukut refinery, because that's more than the cost. I think cost of Renukut and Muri are not too different, but the red mud space available in Renukut is very tight. So as soon as we get more alumina from Utkal, we will probably ramp down the Renukut refinery more. So that is our plan. So between Muri and Renukut, we will reduce the production to what makes sense. Because we still want to keep a little bit of an insurance policy. I don't want to be exposed to having all alumina from one place.
Understood. Reduce the concentration risk.
Yes.
Understood. Thank you. Thank you very much, sir.
Yeah, thanks so much.
Thank you. The next question is from the line of Pinakin Parekh from JP Morgan. Please go ahead.
Thank you very much, sir. So my first question is on Novelis. Over the last 2-3 weeks, there has been a lot of news flow in the U.S. While some auto companies have restarted operations and shut down again, when the May auto sales number came out in June, they're sharply ahead of expectations, and it seems that the shutdown in production sales did, and therefore the inventory gains in U.S. auto is sharply lower. So at this point of time, sir, can you give us more on how is Novelis the key segments in specialties in autos, and also Aleris key segments tracking in terms of demand vis-a-vis what April and May months?
Yeah, sure. Steve, do you want to take that?
Yeah, sure. So I think, as you highlighted, Pinakin, in North America and Europe, we've seen all the auto customers or our customers start to resume operations, and demand is consistent with that expectation of refilling the pipeline and getting all those up. There's been starts and stops as it relates to COVID and so forth, but overall, it's starting to ramp smoothly.
In Asia, auto is running very strong from a production standpoint. There is strong demand in Asia for domestic premium EV and SUV segments, as well as we're picking up a little bit of extra demand because of some of supply chain issues from European European OEMs from supply chain disruptions coming from Europe. When we start to talk about the other segments, CAN, as Satish highlighted in his prepared remarks, is a recession-resistant segment overall, and it's holding up very well in North America and Europe, and strong in the other regions as well, although a little bit more affected due to COVID-related lockdowns. Specialties is a mixed bag. We see some strength in North America as North America starts to unlock from COVID. Some strength in Europe, both from opening up of the economy, but also some new segments that we've been able to move into. And again, in Asia and in South America, still a little bit weaker in trading the two larger regions for us. And then finally, with aerospace, I think aerospace itself, the order backlog as we entered into COVID-19 was very strong. I think we still have to monitor the overall medium to longer term outlook as it relates to aerospace and ability for the airlines to actually procure planes, requiring the build of the planes themselves. And so that's something that we continue to monitor throughout the next several months, several quarters.
Understood. Acquisition.
Sorry to interrupt you. I'm so sorry to interrupt you, Mr. Parekh. Your voice is breaking up, sir. Can you please check on that?
Sure. Just to go back to the Aleris acquisition, there was a certain synergy number that was expected. Now, does the COVID-19 disruption mean that the synergies will get pushed out to next year or year after, or do you expect management expects to get as much of the synergy number as was expected in FY21 itself?
Yeah, so the synergy numbers actually will not change. Maybe they'll be a little bit slower only from the aspect of ability to capture them with the remote working environment that we're in right now. But the synergies are more your traditional type synergies around procurement, supply chain optimization, SG&A, some operational efficiencies. These aren't top-line revenue synergies that we were looking for. So there would be no change in the outlook for the synergies as it relates to our ability to capture them.
Understood. Thank you very much.
Thank you. The next question is from the line of Amit Dixit from Edelweiss. Please go ahead.
Thanks for taking my question and congratulations for good performance. I have a couple of questions. The first one is on your coal sourcing mix in this quarter and how it is likely to pan out considering that Coal India's availability has improved. So will you be using less coal from your own mines? And if you can also throw some light on coal cost per GCV.
Okay, so Q4 already we were taking a lot of coal from Coal India and not from our own mine. So the mix was 60% linkage, 35% e-auction, 2% from own mines and 2% import. That was our Q4 mix. I think in Q1 I doubt whether we'll import any, so it's going to be largely Coal India linkage and auction. And we are, on the sort of rupees per million kilocal at the low 900s right now.
Okay, thank you. The second question is essentially on standalone balance sheet. So if I look at this standalone balance sheet, your short-term borrowings have gone up compared to last year, while payables have fallen. So is it specifically a quarter phenomenon, or is it going to be this way as we go here?
No, there is no quarter phenomenon here. Basically, in March end, because of the sudden lockdown, we drew on our working capital lines, and that is why you will see while short-term loans have gone up, the treasury balance has also gone up. Actually speaking, on the net debt side, there is no deviation currently. So it's purely March last week actually, we drew on the working capital lines. That's the reason why the liabilities are, the short-term loans are high.
So we went to a net cash position, if you remember my talk, around 9,900 crores by drawing down working capital lines. So we just got ready for in case there is any prolonged crisis.
Thank you. We'll also line up the current participants, so we'll move to the next question. The next question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Good evening. Thanks for the opportunity. The first question is, now with respect to the whole year aluminium EBITDA, which is roughly around 3,700 crores, do we have a rough number as to what part has come from our risk management activity with respect to forward booking, etc.? And given that the gap between spot and the future hedges which you shared is now much lower than what our position was at the start of FY20, I mean, what is the loss in terms of profitability we are looking at on an annual run rate basis in FY21?
Sorry, I couldn't get the question. I mean, sorry, can you please repeat? There is no loss
sure.
FY21 because of our hedging. Actually, if you look at the hedge position as I was giving, for FY21, we are 38% hedged at 1732. So we'll only be at an unrealized loss if LME crosses 1732.
Mr. Pai, is it possible to share what would we would have gained in FY20 with respect to our hedges? Any rough number in terms of crores, absolute number?
Around 1,000 crores. But this is not just commodity. We hedge, just so that you know, aluminium, the rupee, we do furnace oil by taking crude as a link. We do we do coal. So we do quite a lot of hedging for various input commodities.
Understand. But out of this 1,000, only LME related would be 500-600 crores. Is that a rough correct assessment?
I think I've given enough.
Okay, that's fine.
But by the way, every quarter I give you the hedge position, so you can calculate it.
Sure.
Yeah.
So next question, I mean, assuming that we are not hit with phase 2 of COVID, is it any rough assessment on the volume loss we would have in FY21 across businesses, India Copper, Aluminium, and then Novelis?
So I'll let Steve answer Novelis, but let me tell you, in India business, I think the total loss in volume I just estimated will be hardly 15 KT. And that's because, we just turned down the production a little bit on the current for April and May. So we are not going to see much volume loss in aluminium. And in copper, actually, it will be flat. It will be flat because last year's production was not that great, at 320 KT. We had hoped to do more this year, but the two smelters were shut for April, May, so we have lost 2 months of production. But the volume for copper will be flat year on year, and aluminium will probably be, we did 1290 sales, because could be at the most 15 KT down from that. Steve, you want to just give your estimation on Novelis?
Sure. It's a little early because ours also depends on in-market demand after we recover from COVID across the world and how demand returns based on economies across the world. Obviously, as I said before, in the early part, first quarter, almost all the North American and European automakers were shut down, which will have an impact on us. They started to recover in the second part of this first quarter, and we continue to see that ramp up, and ultimately we need to see what the demand looks like. When we look to Asia, Asia recovered very quickly from an auto standpoint in China, and continues to see some strength going forward, but still some areas for us to look at in the outer second half of this fiscal year for auto. Can, I said, is recessionary resistant and is holding up quite well, so we don't see a material impact in the can business. and in specialties, a little bit more of a mixed bag across the world. Again, probably more dependent on in-market demand, but so far we see overall a fairly solid return of demand for specialties in the North American and European markets.
Understood. Thanks. And one just last clarification, if I may. Just want to know any fresh assessment of the timeline of divestments of Duffel and Lewisburg?
Steve? Yeah, there's no update from when we updated last. We continue to work with the Chinese regulators as to getting the Liberty House Group approved for the as a buyer of the Duffel facility. And again, as we said before, expect closing of that in the late first quarter, early second quarter time frame. And again, that was a purchase price of 310 million euros. And Lewisport still early. Lewisport was part of the integrated operations in North American Alaris entity, and we're still working to carve out the financial statements and prepare to take that out for marketing.
All right, thanks and all the best.
Thank you. The next question is from the line of Hitesh Shah from Investec Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, sorry for the repetition part, but can you please repeat the hedge quantum that we have for FY21? And a related question, what was it for FY20? And is it possible if you could help us understand with the cash flow from operating activities, there are two line items. One is realized gain loss from cash flow hedges, and second is loss of gain and loss of investments measured from FVTPL. That's the first question, sir.
Are you talking about, for the second part of your question, the OCI? Are you taking the SEBI results?
Yes, sir.
Okay.
Cash flow. Standalone.
Okay. So look, FY21, again, we are 38% commodity hedged at 1732.
Right.
That's the FY21.
Right.
Okay. Out of which 36% is commodity only at 1,711. Currency overall is 37% hedged at 75.93.
Okay.
Last year's hedge position, I thought I give it every quarter. I don't have that handy to you. So we will get back to you what last year's hedge position was.
Right. And sir, the way in which you explain for copper accounting, is it the same way it works for aluminium? Because honestly, to get the actual normalized EBITDA per ton, it becomes a bit difficult given we don't have hang on where the premiums are, physical market premiums. So it becomes a bit difficult to derive the actual cost. So if you could help us how to navigate this, it could be quite useful.
Yeah, the first thing is copper and aluminium hedging is completely different because the aluminium is in many ways a view based because we are sellers of aluminium, whereas the copper is an offset model because all we get is the TCRC. We are not strictly selling copper at market prices because we are not a mining company. So they are two completely different things. That's why the offset hedging is a bit more complicated. That's why Praveen was trying to explain that. Maybe best, if you want further, he can do it offline. So it's fairly difficult. I think that, for your question of sustain going forward at the current TCRC rate, if copper performs, it should be around the 250 crores per quarter is the EBITDA you should expect. At the lower TCRC, yeah? Because remember the TCRC this calendar year now is 15.9 cents per pound compared to the 21 cents that we had last calendar year.
Right.
And okay, OCI, sorry, what's the OCI question?
So, your question was about how much of this is related to. If you see the statement which is attached to the standalone accounts,
right.
For the quarter you see 1,713 crores is a large amount, which is change in fair value of equity instruments. So these are typically our investment in shares, and I would guess large part would be in Idea,
yeah,
and some would be Grasim. And all the prices, share prices, if you remember, in March was a complete meltdown across the globe actually. And that reflects the drop in the prices of those shares. At the current level of pricing, this would come back partially. And then the other big item is 376 crores of the cash flow hedges. So that is the part of the cash flow hedge that goes into OCI. So that also moves up and down. But it's a rupee actually depreciated towards the end of the month, and that may be reflecting because of that. So there's a detailed calculation behind these, which are based on separately LME and then rupee, both copper, aluminum, etc. that goes in.
Sorry, so last year, FY20, the commodity hedge was 21.75 at an average LME of 2,158, and the currency was 36% at an average of 70.61. This is last year, right?
Yes. This is helpful. And sir, secondly, you did touch upon the cost savings. We will have a significant focus. Is it possible that there are any quantifiable numbers, and how will we achieve it?
So, both answer of both is yes. I'm not going to give you the exact number, but we are targeting all the discretionary costs, including office space, travel, any discretionary spend, and we are also looking at optimization of manpower. So all of those are on the cards right now. And what we have done, to just give you some, is that we have done the granular calculation by plant, and we are monitoring on a monthly and quarterly basis the results versus that saving that they have committed to for this current year. So we have put a large part of the personal objectives of the managers on this cost saving. Because in our business, we don't control the top line. That's controlled by the LME. But we can control our own cost line. So that's what we are focused on.
Is there any quantification if it's possible?
No, I'll give you progress as we make it.
Okay.
You'll see it in the results. Yeah.
Okay, perfect. Thank you so much for the answers, sir.
Thank you.
Thank you. The next question is from the line of Raj Gandhi from State Bank of India. Please go ahead.
Hi, thanks a lot for the opportunity. The question pertains to Novelis now, given that the can demand in North America is doing good, the downstream unit, ball and all are guiding at 5% CAGR, and auto has taken up some of the hot mill capacity there. So do you envisage, as a country, North America will need hot mill expansions going forward? And is there brownfield or debottlenecking capacity within the system to take care?
Steve?
Yeah, so we do see a longer-term sustainability trend where end consumers want sustainable packages, and we absolutely believe aluminum beverage cans are the most sustainable package. And so we do see that as a long-term trend, not just in North America, but across the world. And we're actively working with all of our customers, including Ball, to debottleneck our facilities and find ways to ensure that we can serve that what I would call as more medium-term outlook around beverage can sheet.
Okay. And in Europe and Asia, over past decade, our ROICs have remained in low single digits there. So, do you see any revival in those geographies? What's your outlook there? Any specific drivers you see for?
Yeah, we don't really speak to ROIC on a regional basis, but we do see some recovery in overall profitability in Asia as we mix shift towards automotive, and have added the facility with the Aleris acquisition in China, where we'll both be able to capture a higher margin aerospace business as well as integrate the two facilities. And in Europe, we continue to look for ways to optimize the overall footprint from a cost standpoint, as overall market conditions from a margin standpoint probably are a bit more flattish than what we've seen over in Asia.
And Steve, you probably want to add that the shutdown Ludenscheid, I think you declared a 2 quarters ago, I think, to optimize the plant. Maybe you can just update that as well.
Yeah, that's a great example of optimization of where we've been able to take our asset footprint, reduce it, but be able to continue to shift the capacity that we had at Ludenscheid elsewhere, and continue to optimize on the kind of fixed cost basis. So I think that's a great example, Satish.
Thanks a lot.
Thank you. The next question is from the line of Amit Murarka from Motilal Oswal. Please go ahead.
Hi, good evening, everyone. Just the opening comments. So just wanted to understand, given that the domestic demand has been weak in the COVID situation. So while I understand that the production has been lower, but not by too much. So how are we managing the exports? Or basically, how would the share of exports been in the recent months of COVID?
In April, it was 90% exports. In May, it's about 80% exports. And in June, we are starting to see finally some domestic demand pick up. So Q1 is going to be 75% of it is going to be exports.
Okay. Could you also delve a bit into what is realization hit in exports, and commensurately, is there any cost increase as well in terms of rate and other aspects?
Not really. Look, normally the delta between export and domestic is a little bit your import duty that you get on the domestic metal minus any discounts you get. So normally it's about 3,000-4,000 rupees a ton. But the very interesting fact is the exports were going, and because there's a good contango, a lot of metal is being bought by traders at pretty good premiums. So the delta between export and domestic in April and May was not very high, probably 2,000, 3,000 rupees. And so hence I think that exports have been quite a useful pressure relief valve for us in Q1.
Sure. And could you also give a guidance or your view on how export sales could pan out in, let's say, 2Q or subsequent quarters, or it's a wait and watch as of now?
So look, normally the budget 50-50. Last year it was 60% export, 40% domestic. So if you ask me, I think by Q2 we'll be getting back to that run rate. Maybe 65% export, but by Q3 we'll be back to domestic being more than 40% is my estimation.
Okay, sure. Thanks. That's all.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question. I now hand the conference over to the management for closing comments.
Yeah, thank you very much. I think that, I just wanted to reiterate that while our short-term focus is navigating the crisis, and we are going to do that with a lot of detail to get our costs down and make sure that we protect our assets and balance sheet and our people, we will not take our eye off the longer-term projects and the longer-term things that are important for the future of Hindalco. So I think this balancing act is what we are going to be focused on. Short-term crisis dealing with, but keeping sure that some of the more important things we continue to focus on and we do. So with that, I just thank you for your time and attention, and wish you the best and stay safe. Thank you.
Thank you. On behalf of Hindalco Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.